Securities offered through Tj Stearns, a registered representative of Crown Capital Securities LP, member FINRA SIPC. Content is intended to provide accurate information, however, is not intended as financial, tax, or legal advice. Please consult a financial, legal, or tax professional for specific information regarding your individual situation. Opinions expressed and provided are for general informational purposes only and should not be considered a solicitation for the purchase or sale of any security.
Welcome to Protect and Grow with Chicagoland certified financial planner Tim Stearns of Tj Stearns Incorporated. Trust, respect, and results. Tj Stearns Incorporated focuses on comprehensive financial planning and benefits.
Welcome into the program. This is Protect and Grow Chicagoland Retirement with Chicagoland's certified financial planning professional and financial investment and retirement resource. He is Tim Stearns, CFP. Tim, so glad to have you back on the program.
Peter, thanks for having me. I look forward to the next hour with you.
Well, there are many areas, Tim, where savers and investors are understandably concerned right now. And the Fed continues on their path of raising interest rates, which is affecting the market, leading to market volatility. We actually just finished the worst first 6 months of any year since 1970 in the last 52 years, and the second worst 6-month period altogether. So, Tim, what are savers and investors to make of all of this right now?
Well, it's interesting that those you lead with those two stats because I'm well aware of that. What I've noticed is people are coming in and asking us, have we turned the corner? I will say this, that when you know that the Fed is going to keep raising interest rates, and they said they're going to do this through the first quarter of next year, then you have issues. Usually that does not bode well for the stock market. So do you run away and hide, or do you keep your head on a swivel when you're in the market? That's what we do. We don't do a buy and hold. These different people that different strategies of sitting and waiting for the hell and high water to come is not our cup of tea. We get out when we have to because we're not going to sit there and watch the carnage. So that, I understand that people are worried about it, but I know that, the only way we're going to be able to stay above inflation is through equities. So taking your money out and burying it in the backyard isn't a great idea. And so is leaving your money in the market the whole time and doing a buy and hold. We talked about this the other week. I literally had a gentleman who came in here from the radio show who said that his advisor told him his $1.6 million would go down to $1.1 million by the end of third quarter. And then by the end of fourth quarter, he'd be back up into the 1.6 million. So I ask you, why would you wait to lose $500,000? I think it makes a smart move to maybe get out and not take the elevator down, of losing money.
Well, if you've got questions or concerns, ladies and gentlemen, before we get going into these important topics and conversation, I do want to remind you that Tim Stearns CFP is the resource here on the program, but also your personal resource. If you've got those questions, if you would like a planning strategy review, if you'd like to put that plan together or get that written retirement income plan, the Protect and Grow plan available there at Tj Stearns Inc., pick up the phone and give a call, 800-640-2256. That's 800-640-2256, 800-640-2256. So, Tim, we are seeing a turbulent market. What has led to this market volatility, which is one of the top concerns on the minds of all savers investors, I feel?
Well, people are wondering what happened. I mean, we go back to what I said. In 2021, everyone thought the market was just going to keep rolling. And the Fed had said inflation's getting out of control. We're going to probably have to temper it down. And how they do that, they raise interest rates. And that's a lot of what's caused this. I will say this, the horses are already out of the barn, while they're trying to shut the door. So, I know that a lot of investors are worried about market volatility, but we have solutions here. And I'll say this, for the next 10 callers that give us a call with over $500,000, I'll be happy to get the book Income Allocation, which speaks to not buying and holding in this volatile market, but rather being active, strategic, and tactical so that they can actually try to get an alpha that is a good return on the market, even though it's going to be choppy.
Well, if you would like to take advantage of that opportunity to address market volatility in your portfolio and to receive a copy of that essential retirement planning strategy guidebook, Income Allocation, pick up the phone now and give a call to TJ Stearns Inc. and Tim Stearns CFP, 800-640-2256. That's 800-640-2256. Tim, another big concern for savers and investors, but this one particularly retirees, that is exacerbated by the market volatility, is running out of money. What do you discuss with retirees or pre-retirees that can help to address and alleviate this concern?
Well, I'll start with doing an income allocation plan. If they haven't done so yet, now's the time to do it. When you're worried about running out of money, if you do an income allocation plan, then you know that you have enough money, or maybe you find out that you don't, and that you might have to do some different things, maybe cut back, maybe keep working, maybe go back to work, if you haven't been the best saver. So I know a lot of people are concerned about this running out of money, especially with, there's two effects here. Number one, the market's gone down. Number two, if you're pulling money out, that exacerbates the problem, right? You're actually, it's a double-edged sword there. You're actually taking money when the market's down. We call that sequence of returns risk, which is covered in the book that we just spoke of, Income Allocation. But what I'll offer to people out there, I know they're concerned about running out of money, and so would I be, because most of us don't have pensions. I will offer them an income allocation plan for anyone out there that has over $500,000 in assets. I'm happy to sit down with them and get them a plan. There's no obligation to go with us, but wouldn't you like to know whether you're going to have enough money to make it through turbulent times and great times?
Well, once again, if you would like that book, Income Allocation, and if you would like the specific written Protect and Grow plan offered by TJ Stearns Inc. and Tim Stearns CFP, pick up the phone now and give a call, 800-640-2256. That's 800-640-2256. Tim, having that plan in place is going to specifically address that concern of running out of money?
Yes, because we actually show them how we can use maybe a fixed index annuity or one of our funds that throws off dividends every year, rain or shine. We use what we call the aristocrats, and the aristocrats literally have pumped out money for over 25 years plus, in dividends, regardless of what's going on in volatility in the market. That's a great fund that has a long track record. So if people are, skittish on fixed index annuities, that's one way we can do it. But a lot of people like the guarantee of a fixed index annuity. So if they are concerned about that, an income allocation plan will deliver the goods to them as far as knowing that they have enough money, even in volatile times, to pay the bills.
Tim, how can I spend with confidence in retirement with this fear constantly lingering?
Well, if you don't have an income allocation plan, that I doubt that fear will go away without having, it's like having an ailment and not taking your medicine. I think income allocation plans are worth their price in gold, because basically it tells you, what, it's okay that the market's down. I still have money over here, that I can pay my bills. And that helps people sleep better at night. 1 out of 10 Americans have an income allocation plan, which is shame on us, because a lot of us don't have pensions. All we have is Social Security as guarantees. So we need to know, where are we going to get our money when the market is dismal?
Once again, if you would like to have that Protect and Grow written income allocation plan for retirement, pick up the phone and give a call, 800-640-2256. That's 800-640-2256. Tim, by shifting our focus and generating income from our portfolio, does that mean that we are giving up on the goals of growth and gains?
No, because you're going to, let's go with the bucket theory. Okay. That's what a lot of people like to talk about. So you're going to have a bucket of growth money, right? That's going to be in the stock market. The thing I will do with that, what I would do with that investment, is that I'd make sure that you have stop losses and that you're active and strategic, and you're changing up what you have in that portfolio to make sure that you're, getting an alpha, an advantage over the market that I don't think most mutual funds can carry. When we're dealing with our institutional partners on investing, I think we do carry an alpha. Most of these companies that I'm dealing with for our institutional planning has been around since the late 80s, and they really do a nice job, and they've bolted very well during this volatile market. My mom, who's 93 years old, is in some of the funds. So, I need to make sure that we don't lose her money. I want to go to Christmas every year at her house, right? So I'm just kidding. But seriously, that is the type of markets volatility that we're going to cover with people and make sure that they know exactly what they're getting themselves involved in.
The specific Protect and Grow Written Retirement Income Plan available there at Tj Stearns Inc. from Tim Stearns CFP, helping to address the fear and the potential reality of running out of money into retirement, maintaining your comfort, confidence, protecting your lifestyle. If you'd like to get that put together, pick up the phone and give a call, 800-640-2256. That's 800-640-2256. Tim, of course, the topic of concern that is on everybody's minds and lips is inflation.
Absolutely.
How do we address it? What do we need to understand about inflation, and then how to plan for it?
Well, we have to understand that the Fed is doing their best to kind of curtail that, and it's started to come down a bit, but it's not, it hasn't done its job yet, and they know that. I've never seen the Federal Reserve so outspoken as to what needs to be done. Usually they're kind of cloak and dagger behind the scenes. They are saying that through the first quarter, they're going to try to address this of next year. So with inflation, you need to have some equities to stay above it. And that's why we're showing people that we're buttoning down the hatches, if you will, and making sure that we are getting in good funds, good stocks that are going to be bellwethers for this choppy market to stay above inflation. You can't go bury your head in bonds. That's not going to cut it. So you're going to need to look at something, with stocks. And we have definitely great portfolios that will carry that.
Tim, the Fed seemed kind of surprised when, despite raising interest rates, year over year inflation numbers still came in at 9.1%. What does a 9.1% inflation rate mean on my nest egg of $1 million?
Well, we have a couple things going. Number one, you have people who are scared of the stock market, right? And they might be getting out or they're just sitting on the sidelines in cash. So what that means is that if you're earning about, let's just say you're earning 0.10% on your money, in your savings, and inflation's at 9%, you're losing 9% of your money. So what do you do to get ahead of that? You're going to have to look at other vehicles, so open your eyes out there to other things like equity portfolios that have stop losses, because when this thing comes back, it's going to come roaring back, in my opinion. And so what happens there is that you don't want to be on the sidelines and miss out on those opportunities.
Even with safe money, then, Tim, air quotes there, but if our money was sitting in an insured savings account of some type,
yep,
that $1 million basically lost $90,000 of purchasing power as a result of this inflation.
Yes. And put another way, if you're still working, about 1 out of the 12 months, you're working for free due to this inflation. So that being said, come in and see us and let's fix this. I know people are very concerned about this, and that's why I want to offer to them a free, no obligation meeting with us to go over inflation and what it's done to their portfolio. We have a great spreadsheet that we can run that show people what lazy money does, meaning lazy money being in banks, being in savings that are not doing anything against inflation. Show them year on year what they're losing by sitting in the sidelines.
Once again, if you would like to take advantage of that offer, that opportunity to take a look at your portfolio and what impact inflation is having on your purchasing power and your financial outlook. If you'd like to make sure that you are utilizing the tools, the options, the strategies that can best help you to combat inflation, pick up the phone and give Tim Stearns, CFP, and Tj Stearns Inc. a call. 800-640-2256. That's 800-640-2256. 800-640-2256. Now, Tim, this is an interesting one because to combat inflation, the Fed essentially is trying to challenge the market, is trying to challenge the economy and slow it down. How do they go about doing this, and is it working?
Well, what they are doing is they're kiboshing a lot of NASDAQ stocks out there, right? Because NASDAQ stocks are usually growth stocks, right? And they borrow money to do their research and development, R&D. Well, the Fed just made their borrowing of money expensive and more expensive, I should say. So when they do that, that hurts the stock price as well. The other thing it hurts is that, let's say you are out there and you're scared of the stock market and you're still thinking that things are like the 90s and 2000s, where your flight to safety would be stocks to bonds. Well, what we're finding is that bonds actually are losing their value right now, because think about it, new interest rates are coming out higher for new bonds. So who wants your other bond, right? Let's say I held a bond at 3% and they raised it the other week 75 basis points, or 0.75%. When they raise it that much, now the new bonds are coming out, let's say in my example again, 3.75%. No one wants my 3% bond. So to entice someone, I need to take a loss on it. When I got in the industry in 1994, the flight to safety was bonds, and you didn't have this where if the stocks went down, bonds went back up. Well, now we're seeing both sides of the fence collapse, stocks and bonds. So you better be careful about what you have in your portfolio. I would do analysis of this. I know people are worried about rising interest rates, and because of that, they need to know what's in their portfolio. And by doing that, we can analyze it. We can look at their risk profile. And I would say anyone out there with over $500,000 worth of assets will be happy to ascertain what their risk profile is and what do they have baked into their portfolio. I think they'd be surprised at some of the stuff that they're holding that they don't realize.
Once again, if you would like that risk profile, if you'd like to see and understand where rising interest rates could negatively impact your investment portfolio, your financial and retirement outlook, give Tim Stearns, CFP, a call, 800-640-2256. That's 800-640-2256. Tim, we've spoken many times on this program about how bond values and interest rates have an inverse relationship. And yes, conceptually, I think that's a little bit difficult for people to just surface level get the initial understanding of. But in a microcosm, kind of as an analogy, we essentially are seeing the same thing with rising interest rates and our home values. That's kind of a comparison there, correct? Because as interest rates are rising and it costs more to borrow money, the value of our homes may see a little bit of a cooling off from where they were at the highs of last year.
Right. You're seeing that's happening right now. I mean, a year ago, you could get a 30-year mortgage under 3%. Now you're way over 6%. So that's going to cool off this hyper buying that people had. A lot of money people around here in Chicagoland were selling over ask. What they were asking for their house, they're getting 20, 30 grand over ask. Those times are going to go down, especially when people are realizing, you know what, I can't buy it for that anymore, and I'm not going to pay extra. If it's your forever house, I guess maybe you'd still do that, but most people can't afford that. So, I know people are concerned about this, and we have many resources for people, and we're happy to go through. We have a mortgage person, we have a CPA. What is all these interest rates moving up going to do to what we're borrowing, what bond portfolios we have? One of the things that we talk about in my retirement classes, which again we're going to have them in September 13th and the 15th, at Roosevelt University in Schaumburg, Illinois. Great opportunity to learn about, what interest rates do to your portfolio, whether it be your portfolio of bonds or your house portfolio. What does it do to your real estate holdings? So I would tell anyone with over $500,000 to attend our class at Roosevelt University. We start on September 13th. It's a 4-hour class, not all in one night, obviously, but it's an excellent class. Give us a call. We'll sign you up for it. For those out there that are scared to travel because of COVID and that type of thing, we're happy to do Zooms, but I know people are concerned about these things. So give us a call if you have over $500,000 worth of assets, and we'll get you signed up.
Tim, I heard a stat that speaks to the heat of the movement in the housing market and the cooling. Back in June, I saw a stat that nationwide, 360 homes sold for $1 million or more over asking price. I think that was kind of the last push in the hurrah as we were entering into these higher interest rates. And the impact on the housing market and the economy, Tim, we're not going to see homes stop selling.
No.
We probably will see a cool down, if not almost a halt, in refinancing to lower and lower rates, but people will still be moving, just not as much because they want to, more if they have to or are required to for job opportunity or life circumstance.
Well, you have people out there that have, maybe, they're taking hits in the stock market, so they want to sell, maybe downsize, that type of thing. I see you're going to see that, but I see prices stagnating. I'm not going to say it's a bubble like we had in 2008, but I definitely think, we're going to hit our head on that ceiling that was just crazy a year ago. So at the end of the day, my belief is that you're going to see a slowing down of purchases, and people aren't going to sit there and try to overbid to get that house, because there's going to be more inventory than buyers.
Well, again, if you've got questions or concerns about how this could impact your financial outlook, pick up the phone and give Tj Stearns Inc. and Tim Stearns CFP a call, 800-640-2256. That's 800-640-2256. Chicagoland, your resource to get the proprietary Protect and Grow financial and retirement plan, a written plan for generating the retirement income and for achieving your important financial goals. That Protect and Grow plan will help you to address and identify issues and challenges and opportunities in your planning future. Pick up the phone and give a call to take advantage. No cost, no obligation. 800-640-2256. That's 800-640-2256. Tim, the last subject we're going to have time to cover in this segment of the program, it is a big one. Healthcare and long-term care costs are obviously an issue, obviously something that we need to address, but something that very few of us actually do.
So 7 out of 10 Americans are going over the age of 60 will need long-term care. Unfortunately, that's the truth. 9 out of 10 Americans don't have that. So I'm a big believer in the fact that long-term care standalones are very passe. They didn't work for the generation before baby boomers, and they wouldn't work for baby boomers either. Many of the insurance companies have gotten out of that arena. They've moved into other areas. The thing that we like to do to solve that problem is to lock in right now on rates to have a life insurance policy. My wife and I have one. Basically, it's a hybrid long-term care play. So what I'm doing is I'm having a death benefit that would help with the Secure Act, which we've talked about that before, where people have to drain the IRAs of their loved ones when they pass away within 10 years. And then also, as I said, 7 out of 10 Americans are going to need long-term care. So these life insurance policies they can't do 2 of their 6 activities of daily living, then they're able to take money tax-free out of the death benefit of the life insurance policy to pay for that care. My wife and I did it. It's peace of mind that I don't have become a burden on my 3 sons. That's a great way to do that. Plus, I think, just to get off on a little bit of a tangent, I think the estate tax at some point is going to come down to get the middle class, because that's, in 2025 it sunsets. So that's another reason to do it. But at the end of the day, we have rising long-term care costs. It's about $300 a day if you need skilled care in the Chicagoland area. How are you going to pay for that? You wouldn't do without car insurance. You wouldn't do without home insurance. And you have less a chance using that insurance than you do of long-term care. Remember, 7 out of 10.
I was going to mention, Tim, that these hybrid policies almost sound like auto insurance, where If you have routine kind of repairs that need to be done, you can use the auto insurance protection for that. If you've got home repairs that need to be done, you can use the homeowner's insurance for that. And then if you don't have those repairs and you never get into the accident that would require the protection of the auto insurance, that they pay you the benefit at the end anyway. And that sounds like these hybrid policies would make them a little bit more attractive to many people, maybe open up the door to conversations and addressing this issue.
I think it's a win-win, because if you don't use it, someone in, let's say the Smiths come in here to see us, and if they don't use the long-term care benefits and they pass away, well, guess what? It's tax-free death benefit to their heirs. It's a great way to do that. So I know a lot of people out there are concerned about being a burden, being, and the rising costs of long-term care. So come in and see us. There's no obligation. Come in or give us a call, and we can set up an appointment to take a look at what that entails. It's not millions of dollars. A lot of people say, well, my dad never used his long-term care and he passed away. Right, I get that. We're not telling you to do that. We're telling you to do something where there will be a return on the money that you put into there. And that's why we love those policies.
Once again, if you've got questions or concerns, if you would like to address this issue in your planning for your security and protection, as well as your family's peace of mind, pick up the phone and give a call to Tim Stearns, CFP, and Tj Stearns, Inc. for that proprietary Protect and Grow plan for your financial, investment, and retirement future. A written plan for generating retirement income and protecting your assets and your income for life. 800-640-2256. That's 800-640-2256. 800-640-2256. Don't forget that for the first 10 callers to the program, you also can receive a copy of that essential retirement planning strategy guidebook, income allocation, if you have at least 500,000 of investable and retirement assets. So give a call now, request that book, request the time and the opportunity to speak with and sit down with Tim Stearns, CFP, and customize your specific Protect and Grow plan for your financial and retirement future. 800-640-2256. That's 800-640-2256. Tim, always a pleasure. We appreciate your time and the guidance and perspective that you provide on the important issues to face in the planning and financial world.
Thanks, Peter. Thanks for having me.
Tune into Chicagoland certified financial planner Tim Stearns' full radio program on 890 WLS every Sunday at 11 a.m. and visit tjstearns.com for many valuable resources, including other great episodes of Chicagoland Retirement. Be sure to subscribe.
Securities offered through Tj Stearns, a registered representative of Crown Capital Securities LP, member FINRA SIPC. The information presented on this program is provided for informational purposes only, without warranty of accuracy, completeness, or suitability for particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature, not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs.